Numbers. Let's bring in Philip Petursson. He's Chief Investment Strategist, IG Wealth Management. Thanks for being with us, Philip. Takeaways so far from those headlines from the banks this morning?
I would say pretty much what it was expected. So you could see that the Canadian economy was slowing down because of the change in interest rates over the last couple of years. It's put additional stress on consumers, and in particular, as interest rates have gone up, the ability of consumers to pay down their debt. So an increase of loan loss provisioning was, in our view, expected. Now, the level is perhaps higher than what we thought, but this is a theme that I think is going to permeate all of the banks through this earnings season.
Because the alternative is to not provision?
Well, exactly. I mean, it's a recognition of the stress on the consumer, and you have to set aside capital for the potential for loan losses that are coming. Now, these loan losses are emanating out of the fact that anyone that is renewing a mortgage is renewing at a substantially higher rate than the expiring mortgage. And that's putting stress on a certain segment, not every Canadian, but a certain segment of the Canadian population.
It's, I mean, we ask economists all the time about what this rollover of mortgages ultimately means for Canadians, for the economy. Coming into this quarter, there was a general view that the banks themselves were well positioned to handle uncertainty. But I think sort of the broader story of uncertainty is what we're trying to figure out. Like, how much uncertainty do you think there is for Canada's economy right now?
Well, that's the question. I think we get GDP data on Thursday. Q3 was negative 1.1. Expectations are for a very modest annualized growth rate for Q4, but that could be modestly negative as well. Either way, I would say the Canadian economy has been in borderline recession over the last 6 months. If you look at the impact on interest rates, and just use mortgages, anyone renewing a 5-year term today, their interest costs are 50% more than the expiring mortgage. So where's that money coming from? Well, it's coming out of other areas, or there are trade-offs. Some people are being forced to sell their house to downsize into a more affordable mortgage, and others, as we're seeing, are being a little bit more delinquent on their payments.
And then I guess other determining factors like what does the jobs market look like going forward? And, you know, if there is money coming in, that's also a considerable factor on what ultimately you do with higher interest rates, or how you handle higher interest rates.
Exactly. It's not only jobs, but it's also income growth. Right? If incomes haven't grown to catch up with the inflation that we've already seen over the last couple of years, you know, that pie that we have to spend, you know, it's really being squeezed in food costs, in mortgage costs, and in other areas that is taking away from consumption, which is, you know, the broad Canadian economy.
And so if you're the Bank of Canada and you're hearing about big banks on Bay Street that are setting aside huge amounts of money for potentially bad loans, citing economic uncertainty, how do you make sense of that?
Well, you take the data that we have in front of us, which is inflation now in this country is sub 3%. Economic growth is basically flat. That, I think, to me, plus what the banks are saying in terms of, hey, we're concerned about the health of the consumer, we need to increase provisions. That says that the Bank of Canada, I think, should be cutting. And April, I think, is still solidly on the table. If not April, then June.
Interesting, because obviously there's been and it gets complicated because we mix in the U.S., but there's kind of been a growing market narrative that things have been resilient enough that you can push out some of the rate cuts. And I guess if you do ultimately start to see some easing on the monetary policy front, given some of these economic risks, just to be clear about these banks, if they set aside money for bad loans, presumably if those loans don't go belly up, then that can improve your profit picture down the road?
Exactly. And historically, what we've seen out of the banks is they tend to be very conservative or over-provision for loan losses. They'd rather be, you know, protect to the downside. And down the road, as we've seen historically, is that they repatriate this and it turns into greater profits later on. Overall, for the banks, I would just say that, you know, if we're right and the Bank of Canada starts to cut, that's positive for the banks going forward, even with some of the results that we're seeing today.
I was going to ask you just for investors, and last hour we were getting into, or earlier on BNN today, we were getting into some specifics around, you know, what bank investors should do. We did see the banks late last year actually enjoy a reasonable run. It's been a little bit more quiet so far this year. As a strategist, are you recommending Canadian financials to clients right now?
We like the Canadian banks, depending on your time horizon. I sit there and say, look, if you're willing to hold these banks for 3 years, then I think you'll be well served. The banks as a sector are trading between 5 and 10% below their historical multiples, whether it's price to book or price to earnings. The banks are trading more on interest rates right now, meaning as interest rates fall, the banks will do better. So if you believe, as we do, that interest rates are likely to head lower over the course of the next year to 2 years, that should be positive for the banks.
And if BMO and Scotia are setting aside more money for bad loans, would it surprise you if the other big banks this week have a similar message to Bay Street?
Wouldn't surprise at all. I think that's the expectation.
Okay.